Joining us now is Neel Kashkari, a managing director at PIMCO. He was an advisor, as well as you know, to former Treasury Secretary Hank Paulson, ran the TARP program during the crisis. Neel's in Newport Beach, California this morning. Neel, last time I talked to you, we were in Washington. We were talking about austerity. Now we're back to talking about stimulus within a matter of weeks. Do we need it? Do we need fiscal stimulus?
Well, I think that we've learned now for the past couple of years, there have been a number of short-term consumption-oriented stimulus measures, and they really haven't worked. Whether it's been the major fiscal stimulus package, cash for clunkers, homebuyer tax credits, or even quantitative easing, none of them have led to long-term sustainable economic growth. So the composition of what that stimulus money is spent on matters a lot. Boosting consumption in a period when we have a multi-year deleveraging process is flushing money down the toilet. Investing in long-term economic growth, that can make sense. And so we need to get the mix of spending right if we're really going to get our economy growing again. And that's things like education reform, it's things like tax reform, getting our entitlements in order. These things are easy to describe, but very challenging politically.
As we've seen by the inability to get, more than a $2 trillion cut. Or reduced in terms of spending and income. Neel, I mean, we have the president now saying on top of the $1.5 trillion that the super committee has to cut, he wants to add to those reductions or perhaps add to the revenues there. Are you any more optimistic that we will see that happen?
No, I'm not. And I think the markets are reacting to the complete dysfunction in Washington. We now know that these short-term, the easy things that have been tried don't work. What's left are the long-term structural solutions, and yet Washington is at a maximum state of dysfunction. In effect, Washington is telling the markets, you're on your own. You're not going to find any more solutions from us. And so, to me, that's one of the real sources of this extreme volatility that we're seeing in the equity markets. It's because of the dysfunction in Washington and the realization that we have a long, hard adjustment ahead.
Well, the other place that the markets look towards is the Federal Reserve. But, as we even saw with wholesale prices today, that reduction in commodities hasn't meant less inflation for companies or for consumers yet. Are the Fed's hands tied at this point from doing more to stimulate?
I think that they can probably still do some more. Inflation expectations have not taken off yet, so they still have some room to run. But the real question is, what good is it going to do?
Right.
What did QE2 really accomplish? If they announce QE3, in some sense, it's a bridge. But as Mohammed likes to say, what is it a bridge to? If there's not some fiscal adjustment, some hard choices being made by the fiscal authorities, it's just going to have a temporary effect, and we're going to be right back where we are today. And so I think the Fed is very concerned not just about what they can do, but what are the risks of what they do? What are the downside consequences, especially if they're not going to achieve long-term sustainable economic growth?
Neel, were you surprised that we didn't see more abandonment of U.S. Treasuries in the midst of this crisis, given that we're questioning the viability of the U.S. government to continue to pay its bills on time or pay it in an efficient manner?
It's counterintuitive, but at some level, no. Think of a building. Treasuries are the foundation that have underpinned the entire global economy. If you're at the top of a building and you feel that foundation shift, even a little bit, what do? You run down the stairs towards that foundation because a minor movement in the foundation can lead to large swings at the top of the building. So minor movements in treasuries are leading to large swings in the equity markets and in risk assets, and people are trying to move back down to the foundation because they're scared. So it's counterintuitive, but at the same time, I understand it because of the fear and anxiety in the marketplace.
So who has it right then? I mean, is it Fitch Ratings or S&P in terms of the actual, creditworthiness of the United States right now?
At the end of the day, political systems matter a lot in terms of determining sovereign creditworthiness. And so looking at the trajectory that our deficits are on, looking at the maximum dysfunction taking place in Washington, the fact that our political leaders are much more concerned about their own reelection than about doing the work of the American people, it's hard for me to criticize S&P's decision. Until we turn our trajectory of deficits down, I think they made the right call.
U.S. is not AAA, in your opinion?
Well, yeah, looking at where we're headed, I can't see how that we are, given our dysfunction in Washington. If I had more confidence that our political system could actually make hard choices, then I would say, no, we do deserve AAA. But, Margaret, in the last 3 years, we've had 3 bipartisan compromises The tax cut compromise last fall, the continuing budget resolution, and now this debt deal, none of them required our politicians to make any hard choices. They simply defer. They create another committee, another commission. You know, President Obama created his own bipartisan commission, Simpson-Bowles. They did very serious work,
right.
Came out with a very serious bipartisan proposal, and then he ignored it. And so that doesn't lend much confidence in our political system.
Obviously, we always want to draw on your experience of having run TARP. Yesterday, you heard European officials disappoint the market by saying they don't need to expand their emergency rescue program, a financial stability fund staying put. Was that the right call?
You know, unfortunately, no. They are delaying and denying as long as possible because the medicine to actually put out this crisis tastes so bad. So they want to delay taking the medicine and take as little as possible just to try to stabilize things. And that means that they're always behind, always trying to play catch up, and the crisis is always getting worse. We need bold, decisive action to stabilize the Eurozone and the crisis. Now, they have enough balance sheet to withstand the debt. The issue is that their debt is spread around and concentrated around a handful of countries. And so the challenge is the politics of how do you distribute that debt in a fair manner and ask the Germans, among others, to pay for subsidizing their brothers in Greece, in Ireland, in Portugal. And so it's just so distasteful for them to take their medicine. That's why they're denying it and delaying it. But Margaret, let me assure you, they will take their medicine eventually. They'll do it now or they'll do it later. It'd be better if they did it now. It's more likely they'll do it later.
But what is that medicine? What is that? I mean, apart from the ECB continuing to buy bonds, what do the sovereigns have to do themselves?
Ideally, what would happen is the sovereigns would all get together, say Greece, not Greece, Germany, France, the IMF, the ECB would all come out with a massive new bailout package and announce that it's available to the entire Eurozone except for Greece, Ireland, and Portugal. In effect, let those three countries default, but create a firewall to protect Italy and Spain and to preserve the integrity of the euro, the core of the euro area. So this is solvable conceptually. You don't think that firewall's already been
breached for Italy and for Spain?
I think if they came out with a massive new package, they could reestablish that firewall. I don't think it's too late. But again, the challenge is politics. How do you get the German taxpayers to agree to write these checks? Unfortunately, more and more of the burden is going to fall on the ECB. So there's been a lot of talk of a common euro bond, which is elegant conceptually, hard politically. More likely what's going to happen is the ECB will just end up putting so much of this debt on its own balance sheet. And then ultimately Germany may well need to bail out the ECB. It may well be easier politically to ask the Germans to bail out the ECB than to bail out the Greeks and the Irish. But that may ultimately be what happens, and the economic effects may be similar. And so we're going to get there one way or the other. Are we going to get there sooner rather than later? Less painfully rather than more painfully? You know, we'll see.
Are U.S. banks capitalized to withstand that at this point?
You know, I think so. From a direct effect, I think the U.S. banks they certainly have far more capital than they had a couple of years ago. And I think the direct effects of contagion from Europe, they're probably strong enough to withstand that. The question is, what does a disruption in Europe mean for global economic growth? What does that mean for American economic growth? And then what are the second order effects on our banks? And so this is something policymakers in Washington are watching very, very closely, continuing to run stress tests on American banks. I think they're going to be okay, but we need Europe to get its own house in order while we deal with our situation.
Absolutely. Neel, it's always good talking to you. Thanks for your time today.